they've used short profits to add to these shorts. So the specs, it's not just a question of rinsing them here. They've used that margin. They've used those borrowed chips to borrow.
That's amazing, Andrew. Now, in the last episode that we did just 2 weeks ago, on the 27th of July, you noted that the house, as you call it, was about to start ringing that cash register on the speculators who had bet short against the house. Since then, we've seen both the gold and silver prices rise, and this process is starting now. What do you see, and where are we heading with this?
Yeah, Shane, as we indicated, once the house sucks all the chips out, the specs that they can afford to even buy and play, they move to ring this register before, as we say, others compete to do so. So obviously events like non-farm payrolls last Friday and CPI, which we just evidenced today, feeds. We see the algos feeding and hunting out straight speculative orders. But how are they able to do that? The house is so well structured against a lot of layers of very attractive spec short stops, which, as we said last time, should extend all the way back into where they started in March or April, really, more like in April, which we said last time really should be around 1900 gold and 25 silver. So this is where their short stops go up to. So wrong-footed, in essence, they've used short profits to add to these shorts. So the specs, it's not just a question of rinsing them here. They've used that margin. They've used those borrowed chips to borrow more chips, to the point where as we just said, if there was some sort of black swan event, they would be wiped out. And so they've really added and tripled down and doubled down and tripled down. This creates an explosive potential situation with this house at any point ready to pull the trigger. Very confident if you own the house, then you are confident. But Shane, from a longer term perspective, that question kind of leads us into more of what the court case against JP Morgan's traders has really uncovered, because this fresh piece of officially sanctioned manipulation, this is another piece of the manipulation jigsaw. What it does is reveal a suppressed gold and silver price, opening up even more central bank buying. And the jigsaw is complete enough for global central banks already feeding on a freshly opened gold window to question fair value exchange price of physical gold and silver if it's been manipulated to this degree on a wholesale level. And as we know, there are 4 market maker clearing members operating inside the privately owned LPMCL, which is the unallocated gold over-the-counter clearing system, LBMA owned, of which JP Morgan is the largest. And according to these court records, JP Morgan at the time of these spoofing activities were holding more than 40% of the gold clearing book, with the other 3, HSBC, ICB, Standard Bank and UBS, really holding the rest of the book. Now, the siloed private daily settlement process has provided these privileged banks the ability to mutually settle gold credit and debit positions with no physical attached, as well as to conduct third-party transfers. Now, we've looked in detail at this incestuous relationship in the past, and indeed, the latest OCC, Office of the Comptroller report, has forced the unwanted Basel III reporting requirements, which exposed JP Morgan and Citibank as controlling 90% of all precious metals derivative. Let's just focus on what the discovery process has revealed to the public, the regulators, and, very more importantly, competing central banks about primary agent JP Morgan. The key thing here is, of course, agent bank. And this is the very same bank that in September 2019 labeled their precious metals trading desk, this was the DOJ, labeled their precious metal desk as a criminal enterprise operating inside the bank for nearly a decade. Well, it was also revealed through the discovery process, though, that while rigging the precious metals markets for their own preferred clients and their own book, always to the downside to protect these derivative bets. This criminal enterprise was also acting as an agent for the BIS and the Fed. Now, this is a major disclosure. And I think if I just read what Bloomberg said, because it's much better, they sum it up, it's not me. Quote Bloomberg: another set of JP Morgan's important clients were central banks, which trade gold for their reserves and are among the biggest players in the bullion market. At least 10 central banks held their metal vaults run by JP Morgan in 2010, according to documents disclosed in court. Well, they didn't want that exposed, because that actually asserts what we've been saying. So, I mean, essentially, riding the tailwinds of official gold sanctioned gold interventions has from time to time enabled us to identify and report how these position concentration footprints have so blatantly exceeded intraday position limits for a single entity, making it clear that they were undoubtedly officially sanctioned. Well, that was just empirical evidence. Now we have full evidence. And this level of insider knowledge, including knowing in advance such data as non-farm payrolls, CPI data, etc., has enabled these banks to both enrich themselves and their whale clients, which is like Soros, etc., who have skin in the gold shorting game, forward selling options calls, which these banks really have for decades made sure were kept out of the money, often emulating the BIS option structures that we track, hence us focusing on them. Now, furthermore, these court disclosures also reveal the extent of the lock that agent banks such as JP Morgan has historically had on the COMEX to LBMA paper to fiscal imbalance. And while discovery documents from the court also add empirical weight to our assessments of the central bank's role in the gold price containment efforts, we now have blatant confirmation. The insider sanctioned central bank lock on medium and short-term price ranges has really enabled JP Morgan and the 3 other market-making clearing banks to profit enormously from intraday price swings rigged in the interest of their trading desks. But it has also depressed real supply-demand prices for physical gold and silver. So from an intraday perspective, by being afforded siloed smoke and mirrors cover to mutually settle unallocated gold credit positions amongst these 4 banks' books, they've been able to cover their intraday footprints. And while from a medium-term perspective, they've been able to sync these activities with their very aggressive options market containment efforts, all of which have been mutually agreed, or shall we say officially sanctioned, otherwise they would have been investigated and slammed. And this, as a result, when orchestrated with the controlled supply and demand of COMEX open interest, the set ranges that we've experienced have been self-fulfilling. And this is why BIS OPEX, where, as we say, in historically close to $1 trillion of over-the-counter derivatives mark-to-market on the last trading day of each month, a lot less now though, because they've covered a lot, it's been such a major focus for us, as there are only a few very scant occasions when these preset price limits have been exceeded into this BIS mark-to-market event, which is also what the insiders are using as their options containment levels. Now, these discovery disclosures also lift the lid on insider trading infractions conducted by some of the most well-connected Fed insiders and US government officials, such as Nancy Pelosi. Has become reported. In fact, until very recently, these trading activities have been so brazen that it revealed the level of impunity afforded to this insider group, taking advantage of a rigged playing field against the very public that they purport to serve. Now, Fed policymakers have also been caught trading the market on inside information. We are Eric Rosengren, Robert Kaplan. I mean, presidents of the Fed branches in Boston and Dallas, they were forced to resign to avoid actually disclosing more details of their trading positions. They've been trading individual stocks and financial assets. while the Fed was undertaking vast market interventions. This is unbelievable stuff. But more recently, Clarida was uncovered as rotating millions of dollars, millions out of bond funds into stock funds just before the Fed commenced slashing interest rates. I mean, it's beyond comprehension that even Fed Chairman Powell is also an active trader of markets, the markets he influences. Now, this insider track leads further out. Pelosi is just one example of just how leaky this insider track is. And as the New York Post recently commented, the Pelosi's are in a position of influence with access to information not available to most Americans. And they have no shame taking millions while Nancy Pelosi leads a party that is dedicated to virtue signaling about the sins of capitalism. Okay, well, I mean, that's their words. There is undoubtedly an insider loop, though, even if there's no direct evidence of insider trading, because they know how to cover their footprints. However, a lunch meeting, a friendly call, or at the very least, the executing broker knows exactly where these bets are placed. And Greg Smith's footprints in the trial, revealed during this court case, it was just focused on, while they were just focusing on the spoofing tool being used as the trigger points to rig prices, but what it does expose is how known insider information, quite obviously sourced from the Fed insiders determining policy, was being shared with the likes of Soros and other